Hey there. For beginning, myself and Paul just want to remind you that everything discussed here isn't a substitute for formal investment advice and does not represent the formal perspectives of Aquarium Investments. The content of discussion will hopefully interest you, entertain, and supplement your own perspective, but it's important that you conduct your own research or speak formally to a financial advisor before taking any risk with your money. Having said all that, we hope you enjoy the discussion and let's dive in. Hello, Paul. How are you doing?
I'm great, Cormac. How are you?
I'm good. I was just telling you there a few minutes ago that I've had an interesting, frustrating day. So I'm in good form to challenge you on the topics we're talking about today. But I'm excited we're back again for episode 4.
Yeah, a lot of things have happened, right?
Yeah, it's just it's a moving. Everything's moving, and I don't know which is more exciting, to be honest. Is it the stuff that's going on in the world and with the US, or is it that we're on episode 4? What do you think?
Definitely episode 4.
Yeah, I agree. Yeah, it was a trick question. That's the only correct answer.
The world will keep on moving, but
Yeah.
there are only so many episodes.
That's it. Exactly. So today on this episode, we're going to cover. Well, actually, what we're going to do is we're going to review and cover as the topic we talked about back in November, post the U.S. election when Donald Trump had beaten Kamala Harris and became U.S. president. And we're going to review some of those topics we talked about back then, particularly the tariffs and U.S. exports, and we're going to see what has changed and what we think is going to happen potentially going forward. And I'm actually really excited to do this because even when all the tariffs started coming out, I went back and reviewed our previous episode, and I was like, what did we get right? What did we get wrong? And it turns out that I think we got a good few things right. Well, you in particular, and I agreed with you. So I think it's going to be fun.
Yeah, it's the right time to do this, to talk about this, I think.
Yeah. So today is 24th of April, and yeah, let's get into it. So Paul, could you tell me what you think are the three top news items from the last period since our last episode, and what do you think about them and what's happening?
Yeah, so obviously the tariff thing is making the headlines, right? Everyone's talking about it. There's a lot of market reaction to all this stuff. I would call it tariff chaos. Because one day you're supposed to believe in one thing, and then the next morning someone wakes up and says the exact opposite. So obviously it influences pretty much everything. Markets, trade, all sorts of arrangements. So that's obviously the big one. I would say the depreciation of the dollar and what's been happening in the US Treasury market is very significant. We've kind of touched on this before, and we, discussed the dynamics of a depreciating dollar and what it means for other assets, especially dollar-denominated assets. So we've seen a big depreciation in the dollar, especially against gold, but also against other currencies. And the third one, I would say that the pickup in volatility was very significant. It virtually happened everywhere in the marketplace. So, foreign exchange, obviously, precious metals, stocks, even bonds, even the US Treasury market, it experienced abnormal volatility. So these are the three things. They're kind of interrelated. They're sort of related to the tariffs. But I think the dollar thing and the volatility thing, I think they're more of a sign of a changing system. So tariffs were maybe a catalyst for those. But these are the three.
Yeah, I think it's like we're a European-based podcast or discussion, and you'd think for a European discussion we'd be focusing on what's going on in Europe and in Ireland for me, and Latvia for you, and so on. But it seems like the world is just along for the ride as the US and as Trump decides what's going to happen economically. So yeah, so as he drops new decisions and comes out with new ideas, some predictable, some not so predictable, but as they happen, it's kind of like we everyone else is trying to shuffle and get into position and try and stay afloat.
Yeah.
So yeah, it's been obviously a pretty hectic time, and I know you and I even put back the podcast recording for a week or two because we were saying, Jesus, what's going to happen here? Um,
Something is about to happen.
yeah, like the lid was going to blow off the pot at some stage. Um,
Yeah.
so that's great. So I think that's what we're going to focus on a lot during this podcast, discussing those three areas. And before we get into that, let's do our usual review of key market assets and their performance since our last recording.
Yep, let's do that. So we're starting with the dollar index as always, and I cannot stress enough how violent the repricing has been since our last chat. So the last time we talked, it was at 108. It's below 100 now. So a change of around, what is it, 8%, something like this, 8, 9%, which is a lot for foreign exchange, right? Typically, currency pairs move in a low vol kind of regime. So maybe 5, 6% per year. So, it's a big change. Gold in dollar terms, we've seen gold prices in dollars as high as 3,500. At one point, it was pretty brief, but it happened, and we kind of touched on this. We said that gold was likely to go higher, but obviously we did not expect it to be this big, the move. So, a steady move higher, I would say. In terms of whether it's a peak or not, I would say that we are experiencing a regime change in terms of what the reserve asset is, what the actual safe haven is. So it could rally further, but my expectation is that we are going to consolidate around maybe 3,000, 3,100 or something like this. So maybe some pullbacks are to be expected, but overall, the market is very bullish gold, obviously. S&P 500 and Nasdaq, again, our last episode was basically about how expensive US stocks were. And it was great timing for us, right? Because it literally went up a little bit and then just collapsed. You can see the steep sell-off in early April, and that's obviously on tariff announcements. But it's been going down anyway, right? So it just added fuel to this kind of fire. We picked up a little bit. We're off the lows as Trump is kind of rolling back his weird numbers. But I think we're still not out of the woods yet. I think there are a lot of reasons to be cautious, and I think the technicals are pretty bad right now.
I suppose this climb down as well, Paul, was preceded by a lot of climbing in advance of February, because I know off the chart we can't see it here, but if you went back further last year, it was a very upward trending graph with prices in most companies and so on going up.
Yes.
It's probably not unreasonable that it is decreasing as well in general.
Yeah, it's not unreasonable at all. We've talked about this. There's concentration in U.S. stocks globally. The valuations are very high. They're still very high. So there are plenty of reasons. There were plenty of reasons, and there are still plenty of reasons for stocks to keep coming down, at least U.S. stocks. But like if you kind of zoom out, you'll see that S&P 500 and Nasdaq have gone nowhere for a couple of years. it depends where your cutoff is when you start counting, right? So, but yeah, it had a very good run up, obviously, on all this AI stuff and everything. So, it's not a surprise that valuations are coming down. Okay, so let's move on to emerging market stocks. They were holding pretty steady until early April, and then we had the sell-off, and but it bounced back much better actually than the U.S. stocks. For instance, if you compare an index like HSI, which is the Hong Kong Chinese kind of big cap stocks, to Nasdaq, HSI is up maybe 9%, 8-9% on the year, and Nasdaq is down 12% on the year. So big shift. And the bounce is obviously more pronounced in EM stocks than US stocks, I would say. Oil. So this was the market that suffered most, I would say, in percentage terms, at least. So you can see the run up. We were about above 70 just before the announcement. Then we pretty much collapsed. Almost $12 of repricing in WTI, which is the American oil grade. So most of this move was on the back of expectations of slowing growth and general economic activity on the back of these tariffs. It makes a lot of sense. But also there have been some frictions in OPEC Plus. So some of the members of the union, they want to produce more. So some friction there.
So that explains potentially some of the why everything else that we've looked at has rebounded a lot more as the tariffs have been pulled back a bit, whereas this hasn't. This is sitting lower.
Yes, that's definitely part of it. I think it's important to understand that some of the tariffs are in place, right? So they will be affecting economic activity no matter what happens at this point, at least in the short term. So oil is very sensitive to that thing. It's the stuff of growth, pretty much. Okay, let's move on to U.S. rates curves. You can see how the rates have come down on the most part of the curve, especially 1 year, 2 year, 5 year rates, but they are stubbornly high when it comes to 10 year, 20 year, 30 year. So the long end is still very high. And I think one of the reasons why Trump has been rolling off his kind of very aggressive views on tariffs and all these announcements is because the bond market reacted in the wrong way, not in the way they wanted, right? So at some point, 10-year rates were at 450. You had 30-year at 5. So with the U.S. needs to refinance their debt, which is very acute, it doesn't help, right? So I don't think this part of it went according to their initial plan.
In the context of this discussion around tariffs, this is actually probably one of the most interesting charts to look at compared to last time when we looked at it, because that part you're describing where the 10-year and long-term bond did the opposite of what was expected. I think there was a lot of theorizing about why Trump and the U.S. admin were imposing such tariffs in such a way, and one of the theories was that they would drive the long-term bonds to become cheaper, and then as well as that, when they refinance, what is it, 9 trillion in debt this year, that they could have it at a lower rate. But then, as you said, everything went the opposite way. So that was kind of, I think, a lot of people reached the consensus that Trump and Besant and everyone started rolling back because they saw this the long term yields go the wrong way, right?
I think so, yeah. It's obviously debatable, but normally in a stressful situation and like a crisis-like situation, what would happen is, people would go for safe havens, and normally this would be the dollar, the US dollar, and the US Treasuries. So, and obviously, as people buy the dollar and buy US Treasuries with the dollar, rates go down because it's a mathematical equation. If the price goes up, the yields go down. So they had good reasons to believe this would happen, but it didn't happen,
Yeah.
and that's the problem.
And did anyone ever figure out why? Because it was like, I remember when it was like the tariffs were announced, and the week following, people were watching the bond market to see would it drop, because as you said, they're safe havens, but it didn't drop. It stayed
Mm.
high or even went up a little bit. And the theory was that potentially there was a hedge fund that was maybe going to collapse, or that there was some company selling all their bonds, or some sort of Japanese. I saw a good meme online that there was some Japanese hedge fund that no one has heard of collapsed per our sins in the wake of the tariffs and kept the yields high. But was there any actual like explanation for why they stayed high?
What you're referring to in terms of hedge funds trading is what is called a basis trade. A certain type of hedge fund would go into this trade on a lot of leverage, and it's basically they're trying to take advantage of the arbitrage between a cash bond and the futures equivalent of this bond, and they're literally looking for pennies on these trades. But if you do it in size, they're quite
Right.
lucrative. So it was a theory. I haven't seen any proof that it was indeed the case, that it led to this selling of U.S. Treasuries. But some funds reported losses for sure. But I think the reason why rates didn't go down as they expected is because the world has changed basically. If foreigners are motivated to sell US assets for whatever reason, it leads to sales of the most liquid assets in the first place. And the most liquid market is the US Treasury market. So I think that's what really pushed it. In terms of expectations, well, probably the idea was, we sacrifice the equity market, but we get the yields down. But everything was sold off. The
Yeah.
dollar went down, as we've seen, the stocks went down, and bonds went down. So it was clearly people getting out of the dollar. And I mean, we can argue about the reasons for this, and we'll discuss some of this. But I think it was the shift from the dollar mainly
Hmm.
by foreigners.
And the shift from the dollar potentially into something else, i.e., maybe is there a link there between the gold chart we were looking at and the price going up
Yeah,
there?
definitely.
Yeah.
Because we've discussed how gold has been moving physically to US. It's still moving, by the way. And we know how central banks were very active in buying gold for a long, long time. So yeah, gold behaved as a proper safe haven in this situation, and that explains a lot of its rally, I would say. Okay, let's move on. EM bonds, emerging market bonds. So very similar to EM stocks, sharp drop, nice recovery. Um, so this one is interesting because typically you would see emerging market bonds and equities, but in particular bonds, rally on a weakening dollar, which didn't happen, at least not in the first place, in the first reaction this time around. And I think it's a bit early to make a judgment on this. I think a lot of the selling was just a reach for liquidity. You know, when you suffer losses in one part of your exposure or portfolio, you know, and you have to cover it, you go for the liquid stuff, and bonds, even emerging market bonds, are pretty liquid. So, you know, a lot of this selling was just to, I think, was just to cover margin calls or something
Mm.
like that. But nice recovery. So, definitely important to keep an eye on this in the future.
Mm-hmm.
Bitcoin and Nasdaq with 3 times leverage. So this one is interesting too. We will keep looking at this, right, as we've promised. So it kind of decoupled. There's a lot of talk about how Bitcoin is decoupling from Nasdaq, and you can see it in this chart, right? So it initially went down with tariffs, but then it kind of decoupled. Whether it's something that will stay with us, this kind of dynamic, I'm not sure. I think there is still a lot of expectations for this administration to buy into the reserve, and I think a lot of this strength is based on that. So again, if it doesn't come, or if it doesn't come in a big enough form, I think the correlation will come back. But it's interesting to point out that it's different. It seems to be different.
And this is kind of the ambition that a lot of Bitcoin and cryptocurrency advocates would have hoped for, that there would be a
Yes.
decoupling and that Bitcoin would reflect the movement of gold and become another safe haven like the US Treasuries, like gold, excuse me. You can see the decoupling around when the tariffs were introduced and it started
Mm.
going its own way. I remember before when COVID happened, I remember I was watching Bitcoin then just myself out of interest and watching gold price, and Bitcoin at the time was just following the same price as or the same direction as equities, and gold was going the literal opposite direction. So it's actually interesting now to finally see this decoupling that you're pointing out here.
Well, it's very short term still, right?
Mm.
We're talking about a couple of weeks of it being different. Yeah, well, when the stress was at its highest level, gold was rallying and Bitcoin was falling. It was just not falling to the extent people expected it to fall.
Yeah.
You know, it's seen as a very, very volatile asset, which it is historically. So in a situation like this, when Nasdaq is, you know, minus 12% on the year, you would expect Bitcoin to be like minus 30, minus 40%
Yeah.
typically, historically, but it didn't happen. So either the faith in the believer is very strong, or the decoupling is real. So we'll have to
So we
see.
just have to wait and see
Uh,
if the
yeah.
US admin lean into a Bitcoin reserve
Yeah.
or not. Yeah.
Yeah, exactly. But again, if you think about this from the point of view of dollar and how, you know, the world is not rejecting but kind of selling off the US assets, if the U.S. reserve, the U.S. Bitcoin reserve, if it's big enough and if they control the network, it could push people away from it too, I
Mm.
think, because it's kind of you know, if the world is splitting, you kind of have to make that call.
Yeah, this is a really interesting point to me because Bitcoin is since its inception has always been about decentralization and getting away from a fiat currency and US dollar as the primary world trade currency, and the hope was for a lot of Bitcoin advocates that it would become a decentralized global currency, but that is, as you're pointing out, it's like antithetical when you can imagine that
It is.
that like anyone big enough, such as the US or China or one of these BRICS nations, says, "Oh, we want to have the largest we want to have control of the world's largest global currency." Then, as you've just pointed out, what is the rationale for the other countries to then say, "Oh, we're going to also play by that game"? It just doesn't seem to.
Yeah.
Yeah, yeah.
there must be some motivation for the other guys, right? And it just I just don't see it. You have to remember that Bitcoin is not that big in terms of market cap. It's I'm not sure what the number is today, but it's around 1 trillion, I think, maybe 1.5 trillion, which sounds a lot, but you have to compare it to something comparable like gold or U.S. Treasuries or something like that, and it just doesn't compare. It barely compares to Nvidia,
Right.
one
Yeah.
company. So it's easy to imagine some big power controlling it. We are still talking about 2 trillion deficits in US, right? So that's like half the deficit.
Yeah.
So a lot of questions related to that. But my Bitcoin friends are very excited about this. They're very hopeful that it kind of decouples. So we'll see. I'm keeping an open mind about it, but I have my doubts.
Okay. Well, for the sake of your friends, hopefully it'll keep going up.
Yeah, I don't care. I mean, if they make money, I'm happy for them for
God,
sure.
I hope none of your friends are listening and they don't hear you say that.
Why?
Oh
I'm
well,
happy for them
they're
to be successful.
yeah, exactly. Yeah, that's what I meant. That's what I meant. Yeah, yeah. Okay, that was really good, and there was lots of interesting movements in there from the last time. So I think with all that reviewed, we can now move on to the main topic, which is as I think we're affectionately going to name this episode. It's discussion of the Tariff-man striking back.
Yes.
Yeah, Mr. Donald Trump and his tariffs and the US market. And I think just from an overall standpoint, you and I both have discussed before that I think we both shared the belief that something had to happen in the US. And I've listened to countless financial podcasts in the last few months that have explained the world state from a really interesting standpoint, both in terms of the move from this unipolar to multipolar world, and then also from the standpoint of U.S. industry and the economy weakening while spending has gone up in the U.S. And that's kind of set the stage for these sudden movements. Well, sudden to some people, but seemed like, as we were saying, there's something was always going to happen, and it came in the form of these tariffs now, as everyone tries to get to grasp them and get around them. So we're gonna debate that a bit, and yeah, I think it'll be really interesting here to discuss this now. What's your immediate takeaways from what's happened?
So I did say that I find all of this chaotic. So that's if I had to choose one word, I would just I would choose chaos, because again, it's one day it's one thing, this tomorrow it's the rollback, and then we're aggressive again, and it just seems to me it seems like a kind of a smokescreen type of action. It's like a distraction from something else type of thing. In terms of who wins the economic war, well, there are no winners in this war. If we're just talking China and US, and obviously China is the target of these tariffs because Trump has been very quick to roll back most of the tariffs, but not China, because China supposedly is not playing along, or blah, blah, blah. But, if you think about just US and China, they're both likely to suffer in terms of economic activity and growth. But I think I think China is in a better position long term, simply because it's much easier to stimulate local demand than it is to build the infrastructure for this trade and
And
production.
sorry, Paul, when you say they're in a better position, are you saying that they have more leverage or more angles to maneuver in light of the tariffs between the US and China? Is that the what you mean by better position?
Kind of, yes. I think they've got, I wouldn't call it leverage, but I think they're just better diversified in terms of trading partners and who they sell their stuff to. So I don't think they're reliant on US consumer as much as this US admin wants to believe in, you know. They want this market for sure. It's a great market, rich, happy to spend money and everything, so they don't want to lose it. But is it existential? It is not. Painful to lose it, but it's not existential. But like the biggest point for me is the sheer difficulty of building out this infrastructure. Look, China has spent 20 odd years building out this stuff. And it's not just the factories, it's the logistics, it's the automated ports, it's all sorts of agreements. They've been doing it for 20 years, literally, maybe more. It should take about the same time for US to rebuild
And during
this.
that period as well, the US have probably gone the other way or have stagnated during that same period, right?
Well, they just didn't build the stuff,
Yeah.
right? It's you can call it stagnation, I guess, because there is some decay in infrastructure and stuff like that. But they prioritized financialization. Their biggest export was, US dollar and all types of IT services. So that was their focus. It worked out fine, but there are consequences to that, and the consequences are, the loss of jobs and the loss of production capacity, etc., etc. So, like, if you think about security, for instance, it's crazy how U.S. defense is reliant on components from China. Especially all these kind of weird minerals, the inputs you have to use in the building of weaponry and all sorts of equipment. So if they don't sell it, and China has been very reactive. I think they've stopped selling those to US now. So it has real life implications, very quick real life implications for US defense, for instance. Like in a war of attrition, it's similar, but in economics, like who's going to outlast who. And when I say it's fairly easy to stimulate Chinese local demand, I really mean it, and it's nothing to do with China's monetary capacity. All they have to do pretty much is just mirror what the US does in terms of liquidity injections. And we all know that the liquidity injections are coming, right? Trump has been pushing Powell to reduce rates. As soon as we have some trouble in the labor market, they'll come up with some, stimulative measures. I'm happy to bet on this with you or anyone else. I'm actually betting on it in the markets.
Oh yeah.
So I think it's beyond debate that they will do it. All China has to do is just copycat. Do that, and that in turn stimulates local demand, and off you go. And that's even without the other trading partners that would probably, be happy to buy some of the Chinese
And
stuff.
would the injection of liquidity that you're talking about, supposed unemployment rates went up in the US, the injection of liquidity, is that purely to stave off a US recession, in your opinion, or is there other angles to that?
Well, I think it's the typical reaction function for U.S. Administration and monetary powers. They've been doing it in every kind of slowdown, crisis, whatever, for a few decades. So I just can't see them not do that. And it's also a math requirement. With all this debt, you kind of have to keep it going, right? You have to keep refinancing. You have to finance the budget deficit, which is not decreasing. for now at least. I mean, it's still too early, but it's not decreasing in the way that you would want it to be going down, you know. So they kind of have to issue more debt. And then it's important at which rate you refinance the debt or issue new debt. You know, Besant himself, he said that U.S. has a spending problem, not a revenue problem. But they're not doing much to solve the spending part, right?
Mm.
So there's been some debate about how successful Musk is. We've discussed this. It's still to be seen how big of an impact that makes. But also at the same time, if we see a recession or if we see a slowdown, well, given it's Trump, it's difficult for someone like me not to expect some populist ideas, right? And what is the most populist idea of them all is to give money to the people in one form or another, and I think that's where we're heading.
Mm. I find it though. I find I get conflicted when I think about this because I think when we talk about expectations of what a politician will do, it can often be quite rational because every politician wants to be re-elected. So that's like for European politicians, they will always say what, as they call the Overton window dictates, and they will try and move with that Overton window so that they will get the votes in the next election and be re-elected and continue in power. Um, I have to admit that I find this version of Donald Trump, compared to the 2016 version of Donald Trump, is a lot more. Well, actually, you know what I read there? I read a tweet online that someone in the White House was saying, and look, you can always take one of these anonymous sources with salt, but I just thought it was interesting that,
You should.
yeah, you
You
should,
should take
anyone
it with.
should, but that they were saying that he's in a state where it's just like he doesn't really care as much anymore, and he has his own opinion and belief on what should happen. And then you look at Donald Trump. I saw this video from the 1980s when he was on Oprah. Donald Trump was, and even back in the 1980s, it was fascinating. He was talking about tariffs, and he was talking about China, and he was talking about the moving of U.S. industry and production out of the U.S. To cheaper alternatives. So it's like it's a frame of mind he's obviously had for the last 20, 30 years. So
Mm.
I often wonder, when we say, oh, this is what a populist leader will do, they'll give money to the people. I can't help but feel with Donald Trump, you could really get anything. Like you could get him just saying, he doesn't care. He's going to do this one way or another, and just do it. Isn't that kind of the way? Because even when we were talking about tariffs back in November and we were discussing whether they would happen, and even outside of the podcast discussion, you and I were debating it, and I think we both had a shared belief that a lot of the tariff stuff was threats and it was leverage for getting allowances from other countries rather than actually the direct implications of tariffs. But then everyone in the world has been proven that that's not true. He wanted to implement these tariffs, and okay, he's rolled back on some of them, and he's gotten concessions from certain countries, but the tariffs are still in existence now, with like 10% across the board for everyone, and
Mm.
140% or whatever for China. So I always wonder about Donald Trump. Like you can say, oh, a rational person would do it this way. I'm not saying he's not rational, but I think he's very strong in his convictions, whatever they may be.
Yeah. He's full of surprises, this guy, for
That
sure.
that's the
So,
short way of saying what I just said. Yeah.
it's also a problem. It's kind of his super skill, but it's also a problem because it brings about uncertainty. When you're trying to keep the dollar as the sole reserve currency, and when you're trying to keep your U.S. Treasury market as the collateral market, the uncertainty and the lack of trust and the lack of transparency is a problem rather than an achievement. It makes things very difficult to predict, and not just for your foreign partners. It's also making it difficult to plan for local businesses.
Mm.
American businesses. I've seen a bunch of these videos. I mean, these are anecdotal kind of viewpoints, I guess. But these are real businesses, real Americans, and they they're very pessimistic in terms of what the tariffs will do to their businesses and whether they'll be able to keep the staff and all that.
Mm.
There's a bunch of people with inventories that they paid for, but they can't take out and sell because of the tariffs. There's definitely been a slowdown in activity. You can see it from ports data, like you can look at LA ports data. It's been decreasing fast. These things, they influence your own economy and your own people and your own employment. And there's no way about it, basically. And, at the end of the day, these are threats and these are kind of obnoxious requests from your partners. And I think, to me personally, I don't think that it was the tariffs themselves that influenced the market so much. Because I think everyone expected Trump to kind of threat and pull back and, art of the deal stuff, all these kind of mind games and, trade games. You kind of expect it from him. And even these huge tariffs on the announcement, they weren't unexpected. I mean, the magnitude was unexpected, but we were expecting tariffs, right? It was broadcasted well in advance. The 2nd of April was the date, all this stuff. But I actually think it's the overall position of this administration that led to this market reaction. And I've sent this interview to you of this guy by the name of Steve Mirren. I'm not sure you've listened
I
to it.
listen to everything you send me, Paul.
Oh, poor soul. You shouldn't. You should pick and choose. But it's very important, this one, because Mirren, he's the economic advisor to the White House. And he made this speech at Hudson Institute. And he basically laid out the view of this administration on how the world should proceed, basically economically, and how the interaction in terms of monetary side of things should happen further on. And it was basically first he said how much U.S. has suffered from all this dishonest trade and all this stuff, which is it's it's a lie basically to someone like me. U.S. has benefited immensely from the dollar status over the decades. The fact that your flyover America suffered, yes, it's true, but it was a conscious choice. And some parts of the economy benefited a lot, like banks and finance guys. Big businesses, they benefited a lot. And then he goes on to say that, despite this, we have to keep the dollar as the reserve currency. And, there are ways to do this. And basically, he then goes on to list all these ways that this could be paid for. And there are different ways, right? You can, pay money to the treasury. You can pay the tariffs. You can buy century bonds. Basically, pay in one form or another, right? So, and I think that speech, and it was just before the tariff announcement, maybe a couple of days before, I think that's what scared foreign capital more than the tariffs themselves, because in the context of the speech, tariffs were just the first ball, kind of like a trial balloon. To see what the reaction from the world would be. And the reaction was to sell the dollars, to sell US stocks, and to sell US bonds to an extent. I think that's what scared the world more than the tariffs themselves. Because tariffs, they are negotiable anyway, especially with a guy like Trump. This stuff, it just shows what the plan is, and it's a bad deal for Europe, for instance. It's a very bad deal for China. Why would they do it, right? Um, I think this administration is overestimating this idea of American exceptionalism. I think that they've taken it too far. But coming back to what you said about Trump and whether he'll do populist stuff or not, well, we'll have to see. But he's the definition of a populist, no?
Mm.
I mean, he's happy to risk the employment and the businesses of millions of people just to stick to his ideology of moving manufacturing back
Yeah,
home.
that is definitely the case. But I think one of the first things we were saying there was that you and I shared the opinion that something had to happen in the US. And yeah, we have a slide 10. Education vote share gap. This chart just indicates the general move in sentiment in politics in the last 30 or so years. And one of the fascinating things for me, well, actually, the fascinating thing, you can obviously see it, is the mirroring between how the Republican Party voting and Democrat Party voting has moved. And a lot of that obviously is to do with the the I guess you'd call it the collapse or the decay of the Rust Belt and the working class American and the middle class American. And I mean, when you think of Trump voters, you think of people who are potentially working class, potentially, a lot of people from the South of Southern America, a lot of people from Rust Belt areas. And a lot of those people seem to get in behind Trump because they have been abandoned in what has happened in the last 30 years in the US, where a lot of US industry, steel works, car production, so on, has moved to China. And I mean, I wonder, we call them populists, but I wonder if, appealing to a base of people that have been disenfranchised and have been left abandoned by the political sphere. Is it populist to say, you know what, to these people, we're going to try and shake it up, and we're going to try and put punishment on cheap foreign imports, and instead try and drive the reproduction of jobs in the US in terms of like steel production or manufacturing. I don't know. The connotation with populism can be funny because people often think of it as just inherently lies or inherently a bad thing. And I guess I view it as populism is trying to appreciate the will of the people or what is actually popular, right? Which is not necessarily a bad thing.
Mm.
So, yeah.
I guess it's down to definitions, right? So for me, populism is doing the wrong thing just because it's popular. That's my definition of populism. But yeah, you could see it as a way to appease your voters, right? And doing the stuff that got you where you are. I guess the problem for me is I agree that things have to change in America and also globally. I'm of a deep belief that the system has basically run its course, and it needs to be changed because it has been pretty bad for everything, including global growth. But I guess it matters how you do it. What Trump is trying to do is some form of shock therapy, rip off the band-aid, suffer short term for greater benefits long term. As you know, I was born in the USSR, and we had similar ideas at the time. You had these guys on television saying, "Oh, we have to go through this economic shock therapy, and it's going to be all nice in the end." Well, all it did was bring suffering. It was just the stupidest stuff that it could have done. For instance, the tariffs thing. I think it will just lead to a huge economic slowdown. If nothing is changed within, a month, maybe 2 months, I would think that by end of summer, we'll see an ever decreasing data, worsening data in US and problems in the labor market and stuff like this. Because the guys that suffer from these tariffs, these are not going to be and I mean, American companies, for instance, these are not going to be your Apples or Teslas, right? Because they'll get exceptions or, exemptions or something like that for sure, because they have access to the White House, to Trump himself. So in all likelihood, it will be the small to medium businesses that suffer. And actually, these are the businesses that make up the most of employment in US. So, if you kill off those businesses or just make them stop their activities, they will let people go. And what happens next? They'll go for jobless claims, unemployment will go up, the Fed will stress out, cut rates, then they'll try to stimulate, and it's a vicious circle kind of thing. So if this happens, instead of decreasing the deficits, they will increase them, because every recession and every economic slowdown leads to a widening of deficits as a percentage of GDP, right? So, and it's maths. You cannot fight it. It's just the way it is. So I think that's the problem for me. I get it that change needs to be done. I get it that it's likely to be, volatile and painful, but you can address it in different ways. You can go for a reasonable deal with China, for instance. You could keep on trying to save or cut some expenses. You basically need a lot of reforms and changes in the way you operate in terms of foreign policy as well. So, you have to be objective about it. And the way this admin acts, they still act as if it's, I don't know, 91 or something.
In what way do you mean that? In that you think when they were all powerful, when they were the primary, the unipolar?
Yeah, just like if you look at the composition of global powers at the time, like say 91 and today, they are completely different. Because China is in a different place, Russia is in a different place, a lot of southern countries, Indonesia, Brazil, they have evolved a lot, especially China. So China today, it's literally challenging the technological supremacy of the West and US in particular, and they're rushing ahead. There's no stopping them, and these tariffs they will not stop them. They will just make them work harder, you know. So yeah, I just don't see how it works. And another thing is US is on a limited time span, I would say, because of the refinancing needs. You mentioned 9 trillion that needs to be rolled over. But like half of it comes by the summer. We're right here. They have to refinance, and the reverse repo liquidity pocket is gone. It's virtually empty, so they have to issue more. So it's like an unsolvable mathematical
Yeah, isn't
equation.
it? That's the thing that strikes me in all of it. So we have a chart called Larger Trading Partner 2000 and 2004, and it's just a map of the world, and it shows you the China and US are the two different colors. Red is China and blue is US, and you can see which is the largest trading partner is what's indicated here. And there's also a circle around each nation, so you can see a circle around the US and a circle around China. And you can see the difference between 2000 and 2024 in that how the trade has grown for both nations, but obviously China has grown multiple times more than the US, and it's positioned this kind of situation where the US is no longer this primary producer of goods. It's producing services, as you said, and it's producing financial services and so on. But China are the dominant force globally in terms of production. And I know historically, even I was talking to someone about this recently, that in the periods of history, there's these things, the Pax, PAX, it's like Pax Romana for the Roman period of prosperity, and where the Romans were dominant, and the world kind of flourished underneath them. And then you had other ones like Pax Britannia, where Britain had dominance of the world, and a lot of that was to do with their naval power and control of the seas, and then their kind of vassal states underneath them prospered in that world. And then since World War II, it's been Pax Americana, I guess it's what it's called, and it's been the same thing. It's like a dominance of the US in terms of production, and also their war ability, and what's being produced and so on. And now we're in this world where it's China has domination of production. It has domination of the export markets. US is weakening. US has sold a lot of its industry and production to the East, where it's cheaper to produce, and now the US are trying to roll it back. But as you're citing, Trump's method, which is a shock and awe method, doesn't seem to be, in our belief, or in your belief as well anyway, doesn't seem to have any positive impact on turning the tide on that. Whereas it seems like they're just caught. It seems like they're really inevitable that the way things are. So yeah.
Yeah, I think it's very telling how China reacted to all of this. They're very confident in their posture. They keep saying, roll back the tariffs and come and talk to us. They're not even negotiating, kind of thing. And I think it's a sign of strength. I think they're pretty positive that they can outlast this economic war as opposed to US. And that should scare the administration a lot, because it's not in the Chinese psyche to bluff. They're not the kind of people that bluff. Well, maybe in the casino, but not on this level of negotiations. There are all sorts of rumors as well. Like there's this going rumor that China has much bigger stockpiles of gold, for instance, that they admit. So if this is true, I think we're about to see it, right? They'll probably announce it soon.
We might be facing Pax China, or whatever the word would be.
Yeah, I don't think China wants to be a hegemon, because the example of US, it just shows that in today's world, in this interrelated global world, it gives you a lot of benefits. It gives you this exorbitant privilege, but it also brings about huge problems. And these problems are on societal level. They're not on economic level. It's not about your monetary policy. It's not about your production capacity. It's about your society decaying, kind of thing. And that's the worst kind of decay, because everything else is fixable. This thing, you kind of have to change the people's minds and attitudes, and it's
Which
difficult.
is really hard when people get comfortable, and when everything is generally prosperous. It's very hard to row back against hedonism and prosperity. Because people want to be fiscally conservative.
Yeah, it's very hard. It's possible. It has to be done. I'm sure US will manage to do this, but it's a very difficult process, I would say. And I would like to point you to another chart, and it's chart 20. And it's from this guy called Thorsten Slock, and he's the Apollo's chief economist. A pretty big outfit. It just shows headwinds to U.S. economic growth, and it just lists all of them: Doge laying off workers, higher tariffs, uncertainty, retaliation, lower tourism, all these things. And you can see it in the data already. You can see it in the soft kind of questionnaire data. It's been collapsing, and that's kind of what I mean by the smoke screen that I mentioned in the beginning, like this dollar thing. This is not what they expected, because this same Bassent, he said, well, yes, we'll raise tariffs, but the appreciation of the currency will take care of 50% of that. That was the expectation. We impose tariffs, dollar goes up, and this way we can buy more foreign goods, and it compensates. But if it goes the other way, it just makes things so much worse, right? It's the other way around.
Mm.
So I think it's a lot of this is just hubris, believing in things long gone. And it's a problem because, like, you have to accept reality as it is. You can't live in an illusion. It just, makes things worse, etc. And actually, we can look at chart 21, and it just shows you how non-typical this period has been, and it just shows you the dollar versus the 10-year Treasury yield.
Mm-hmm.
It's completely different from what you would expect to happen, right? It's not supposed to be this way, and I think it came as a big shock. And there have been rumors that it was actually Bassett that went to Trump and picked his time, and persuaded him to roll back the rhetoric at least.
Sorry, Paul. It's the dotted line is what you're referencing here is completely the ex.
The dotted line is just when the tariffs hit, right? It's Liberation Day. You can see it
Yeah, good old
in the
Liberation Day.
bottom.
Yeah.
Yeah, so you can see how correlated the red line and the blue line are, right? And the blue line is the 10-year yield. So if bonds go down, the yield goes up. And the red line is the dollar index. So whatever, if it goes down, the dollar is down. If it goes up, the dollar is up. So, and this is not a long, this chart is not really long. It's only 2 years long. But this kind of dynamic, it was evident for a long, long time, right? So this is a big change.
Mm.
So what I'm saying is it's understandable why they would expect this thing to go on, right? Because historically that's what happened all the time, but it didn't, and it came as a shock. It was not meant to happen.
Yeah. Well, when you look at the graph, it's pretty. I mean, it's pretty damning, or pretty. I was trying to look back further, and I think the last time I could see such a switch happen was in around the middle of 2023. I see the US dollar index drop and the 10-year US yield going up.
But only
But only
briefly, right?
briefly, and not well. I mean, I guess we're still in the early days of the tariffs, so who knows how long this will go on. But I think it's just the magnitude of it as well. It was like this is severe when you look at the dotted line in this graph, like the current day dotted line.
Yeah, also the period you're referring to, it was in 23, it was the moment when American banking system was imploding. And they had to come up with the BTFP program, which is basically a liquidity pocket for banks from the Fed. So it was another kind of risk-off situation, crisis situation, more or less. So you would expect some distortions there, but it went back to its normal
Yeah.
correlation, right? Very fast. This time around, it doesn't seem to. The dollar is still under pressure. There still seems to be some selling. The equity markets, as we've seen, well, they've recovered somewhat, but definitely not everything. And it's still, as I've said, technically, it's not looking good as of now. And when I say technically, I just mean how forceful the move is in the indices according spread out. Like if you look at all the industries, all the stocks, it's the selling is everywhere. It's not focused on a particular industry. It's everything, and it's because foreigners own so many U.S. Assets. And if you're a European and you own some US stocks, euro dollar rate is important, right? Nobody notices it when it's stable, when it doesn't move. But once it does move, it affects your returns very fast. So, if you bought a US Treasury and it's yielding 4%, say you bought like a 2-year US Treasury note, you're down in return terms because the dollar has gone down 8% on the year, and you're only making 4% on this bond, right? So you're down 4% and nothing has happened. And this influences your decision making, right? If it keeps going down, it pushes you into selling mode kind of thing. It raises a lot of questions for producers of critical resources like oil, for instance, especially in places like Saudi Arabia, because they have a fixed peg to the dollar. So the Saudi rial is pegged in a very strict fixed way to the dollar. So when the dollar goes down, real goes down. And if you couple it with the decreasing oil price, that's even worse, right? Your currency is going down, the price of your main export is going down, and on the other end, you have all these ambitious budgetary expenses. So, it raises a lot of questions, and I think given where gold is today, I think it could act as a magnet to other commodities as well. So things like oil, silver, copper, they kind of have to get closer to gold in terms of ratios, I would say.
And so we've kind of talked a bit there. Obviously, covered a lot of different ground in terms of how the US is set up and how China appears to have the reins in how things are worldwide, and the US are kind of struggling against that, and that's what we're seeing in the form of the shock and awe that Trump and the admin have caused with the tariffs. But have you any thoughts on, seeing as we are a European based podcast and discussion, have you any thoughts on implications for Europe, for instance?
Well, so if so Europeans have been on average, right, in totality. It's very difficult to pinpoint a certain country because it changes from one country to another. So Ireland is a special place in that sense in terms of its relationship with the U.S. and the concentration of big tech in Ireland and the taxation side of it. So it would be very different from the relationship of, say, Latvia or, I don't know, France with the US. So they're very specific. But overall, Europe has been trading with US in a beneficial way. Europe as a whole is still running surpluses, trade surpluses with US. And that was always the deal, you have the reserve currencies, you are the world's policeman, and that means that we accept dollars as the reserve currency and U.S. Treasuries as collateral. But if this is the system, it means that U.S. will run trade deficits by definition. Um, and in return, it will get capital flows, so the capital account will be positive, and that's exactly why you see concentration in U.S. stocks, right? Because once you make some money on trade, these dollars have to go somewhere, and it used to be U.S. Treasuries, but after 2022, it's changed more to stocks because U.S. Treasuries were seen as less reliable because of the freeze of Russian central bank assets, right?
Mm.
But it's still positive in terms of capital flows into the U.S., right? And if this changes, if this is reversed, well, it just means that a lot of money is coming back to Europe.
Mm.
So that sounds like a positive, right? Because that would allow Europe to finance a lot of infrastructural needs or, security needs, build up the army, all the stuff that politicians want, right? You need money for that, and that's just this repricing could lead to, just money coming back. So that's a positive. I also think that Europe is in a better position in terms of, hostilities than China, because historically Europe is an ally of US, right, in different forms. So I think it will be easier to come to terms to come to trade terms with Europe, than China, for instance. At the end of the day, trade boils down to elasticity of demand. So if the good is easy to replace, or if it's easy to produce back home, then that's what's going to happen because of the tariffs. But if it's not, you know, then it's not. It's just going to be sold at a higher price. And that's it. So, so I think maybe some production comes back to US, but I think it's a long process, and I think it hurts US more.
Yeah, but I will say though one thing in that, because you kind of touched on it there, that the EU is a big block of different countries, and if we look at goods exports to US and Germany, it's chart 11. So if you look at this chart, you can see on the bottom axis, the bottom x-axis, that's the uh, percentage of total imports to Germany. And then if you look at the y-axis, whoever made this chart should have labeled them. Bad on them to not do that. But the y-axis is the percentage of total exports to the US, and you can see broadly there that in the bottom bracket you can see a whole wave of different European countries, and most of their exporting is to Germany. But it's kind of topical, seeing as I'm Irish and live in Ireland. That you can see Ireland up at the top, and that indicates that Ireland exports way more to the US than it does to Germany. So I think for countries like Ireland, the fear is that it would have a pretty untoward effect. Tariffs would have an untoward effect, or any kind of economic warfare would have a bad effect on Ireland, especially considering these kind of tax loopholes that are established in Ireland. And then I've had a good few friends as well, or a good few discussion with one friend in particular who works in the pharmaceutical industry, and pharmaceuticals is one of Ireland's biggest exports, and a lot of them are US companies, and the fear is that while it won't probably happen in the short term, according to my friend who explained that a lot of these industries take a long time to establish, you could see some of the taxation, or the funds that are raised by these pharmaceutical companies being rerouted, or potentially shipped back to the US in some way, and having some effect. And I guess it depends on the individual country, and Ireland in particular is a little bit exposed on this front. So I think it's just important.
It is exposed for sure, but I think the reason for this chart and the Ireland being an outlier is the concentration of big tech in Ireland, because they book profits in Ireland. It's not like you know a lot of goods are being produced and shipped off to US,
No.
right? It's not about that.
Well, it is from the angle of pharmaceuticals, because I think pharma is actually our bigger industry right now. But yeah, but your
Mm.
point still is obviously correct, that there's a lot of this finance being moved from Ireland thanks to tech companies. Like there is a lot of tech company money here as well.
You're right about pharma, of course, and there are some exports for sure. The stuff we all like, whiskey and Guinness and all that. But the bigger part of it, and Ireland being an outlier in this sense, is down to the presence of these big corporations in Ireland, and that's a good thing because they hire people, they pay taxes, no matter how small. It's the scale that matters. So, and in all likelihood, these tech guys will stay there, right? They'll still want to deal with Europe. They still want to kind of provide the services in Europe. They need a hub in Europe. And I just don't see them moving to Italy or Germany or anywhere. For what good reason, you know? They'll stay. Maybe the taxation code will change, or maybe they'll have to pay something extra or something like that. But you know, there's been some pushback against big tech in Europe anyway. There've been a few fines announced, quite big, in the hundreds of millions kind of ballpark, just recently.
Yeah.
So, you know, there's some pushback there, and that could affect Ireland, I think. But tariffs directly, I don't think so. And again, these big guys, these are the guys that have the direct line to Mr. Donald Trump. So, you know, they'll get those exemptions for sure.
Yeah.
I mean,
Yeah.
that's just the way American politics works, and you know, there's no indication that it will change. So I would sum it up like this. You know, we're definitely in this period of turbulence. It will continue. I mentioned volatility picking up. So one thing I'm confident about is that volatility will stay high pretty much everywhere, and it's going to be a hectic period of adjustment. But then again, you know, if you think about it philosophically, if the plan is to change the system, and it definitely seems that way, not just in economics, but in geopolitics, in you know, in all these conflicts, how they're progressing, I think it's evident that the system is changing, and it's naive to assume that the this type of change in the system could be done without volatility, turbulence, you know, emotion and mistakes. I think it just, you know, it comes with it. It comes with it. So for me, it's kind of natural even. It's kind of what I was expecting in terms of volatility, at least. It had to come from somewhere.
I think we've gotten to a really good point to finish off for this discussion. We covered so much ground in the different areas that the US tariffs are affecting the world, and I mean, it's a fascinating discussion. You could spend all day discussing and debating, and I've done it with a couple of friends now, and I'm sure offline you and I will do it again. We're just going to be keep on talking about this stuff.
We'll have
We'll
to.
have to, but maybe in a few months when a few more things happen and we're kind of sure of our ground, we can revisit this topic and see how things are shaping up then again. What do you think?
I don't think we have a choice. I think we'll have to.
Yeah, very fair.
Because I think by midsummer we'll see more data, you know, supporting one view or another, and that's actually something you could analyze. You know, whether Musk is successful in his, you know, cuts, and you know, whether the tariffs bring in revenue, all these
Yeah,
things. So it will be
we get
factual.
out of the maelstrom that we're currently in, and we kind of are able to see the ground that we're standing on in order to
Yeah,
see
exactly.
talk about it. Yeah, I think that'd be great to do again. Um,
Yeah, so we'll do it midsummer
yeah,
somewhere,
yeah, we'll revisit this midsummer.
sometime.
Yeah.
All right, great. Thanks for doing this, Cormac. It's always my
No,
pleasure.
thank you very
And
much, Paul.
let's keep it
Yeah,
going.
let's keep going, and thanks a lot for informing me and for such an interesting discussion.